You're listening to the first episode of the Allan Gray podcast. My name is Tamron Lam. I'm head of retail distribution at Allan Gray, and I'm going to be your host for today's episode. We've put this podcast together for financial advisors and their clients, and our aim is that it will cover a range of topics from markets to industry or economics and maybe even personal finance. But at the end of each episode, we hope that you will have been provided with some different perspectives on some topical issues. And also you'll get a closer sense of how we look at the world, particularly when we're putting your portfolios together. Today I'm going to be speaking to Duncan Artis. He's our Chief Investment Officer at Allan Gray. And also we're very happy to have Alec Cutler here, who is a portfolio manager at Orbis, and he runs the Orbis Global Balanced Fund. And the topic of today's conversation is going to be how should we think about investing in an energy short and volatile world. So before we start on the investment part of our podcast, I wanted to ask you both two quite simple questions. So Duncan, you had 2 weeks in an accounting firm before you joined Allan Gray. So maybe you can tell us why investing and why Allan Gray.
Yeah, well, Tamron, first of all, it was a pay at the accounting firm. But no, when I look back, my grandfather was always interested in the stock markets. And in fact, I think for my 12th birthday, he bought me my first ever share certificate. And the company happened to go bankrupt. So that was a good first lesson in how tough investing is. And that kind of went through to my father, who was a runner on the stock exchange. If you remember, guys used to run around with a piece of chalk and mark each of the trades. It was kind of, it came through. I was never sitting every day trading shares, but it's something I was always interested in. But in South Africa, kind of becoming a chartered accountant was sort of this base level of competence. And so I did business science, and then I did my postgraduate in accounting. And after 2 weeks of auditing, I said, no, this is not for me. And I joined actually as an intern at a small stockbroking firm, and then went to a smaller asset manager before I was lucky enough to be able to join Allan Gray. I think at a very lucky time to join Allan Gray as well. So sometimes, you just take the right fork in the road.
Okay, and Alec, so a question for you. What do you think differentiates an average investor from a truly great investor?
I think that's a great question, and not just because I asked it once.
I think I might have got it from you.
in the late 90s, I asked Bill Miller of Legg Mason Value Trust fame. This was when the dot-com bubble was just flying. What separated the great investors from the average investors? And he looked at me square in the eye and said, survival of your personal investing hell. And I thought, okay. And then about a year and a half later, the dot-com bubble exploded, and watched much of the market go through their own personal investing hell. Saw a lot of Porsche driving former traders and growth investors teaching PE at the local high school and things like that.
And actually, talking about the dot-com bubble probably leads me nicely into my first question. So the beginning of this year seems to have kind of reinforced that idea that themes last kind of for a long time until they don't. And we've seen a big pullback in some of the stocks that have been running hard for a number of years, and obviously escalated by the conflict in Russia and Ukraine. So, given that sell-off, given what looks like a lot of volatility, and a lot of this has been commented on, I guess my question for you is, what do you think people are missing?
What I think people are missing now, I think what we're seeing people say now is, man, these things are off 30, 40%, good quality companies, and their PEs are now 17, 18 times earnings. And what they're missing is what we saw in 2000, 2001, which was, that was the same thing people said back then. Then margins crashed. And we're currently sitting at margins that are multiples of the margin in 1999, 2000. So I think we haven't seen the second, third, and fourth shoe to drop on profitability and margins.
Yeah, and maybe just from my side, Tamron, which we spoke about, is often there's a difference between a cyclical top and a secular top. And I think if Alex's thesis is true, that means it's a secular top, which lasts for years and years and years. And so typically when bear markets start in a market or a sector, you have something called the generals, are the only people that are left. So if you don't own the disruptor stocks, you don't own the weaker stocks and they fall, you go, well, that's fine because they were the more speculative ones. It's the Microsofts, the Apple and the Googles. I own these great companies and you feel very comfortable. But when all of a sudden those stocks start to decline, that's when the real bear market starts, because it's like being the general. You had an army behind you fighting the battle and you look back and there's no one there and you're all by yourself. And it really is the last thing that sort of breaks investors' resolve in a long-term bear market, which we could be about to have in American big tech stocks for a number of years.
There's currently no concept in the market in the business media that the Microsofts and Amazons and Googles of the world can have dropping earnings. That's just not even a possibility. So it's when that comes, it will be a shock.
But these businesses have still got quite good tailwinds behind them in terms of fundamentals. So there isn't necessarily a kind of economic backdrop that causes a major shift in the fundamentals, is it?
So some of that tailwind was accelerated during COVID, and competitors aren't sitting still. So Amazon owned the web services cloud space, and Microsoft saw it and said, I want some of that. Google saw it and said, I want some of that. Now IBM and Oracle and everybody else is trying to plow a niche into that. So it's that's the way capitalism works, and the margin should drop there too.
Like I think TikTok has overtaken Instagram in views in the US. I stand corrected on that, but it's pretty close. So you thought no one could compete against Tencent or Meta, and all of a sudden this company that grew out of China has become this global behemoth and is actually attracting more video time than some of the bigger companies. But I think just to counter Alec on the one thing, I think the one thing that is different is that, well, not different, the balance sheets are not sitting with huge amounts of debt. So the one risk of shorting rather than not owning some of the disruptor stocks is Microsoft just might decide tomorrow to spend $40 billion on a share that you think is expensive. So I think that is the one thing to be careful of. Like it's one thing not owning a share. It's another thing shorting the smaller shares where these companies which sit with hundreds of billions, in some cases dollars, of cash in their balance sheet could buy out some of their competitors. And to me, that is the one risk that someone else could pay an irrational price.
And I mean, how do the fact that we're coming off what looks like 4 decades of declining interest rates, and there's clearly a reversal of that, and we've seen inflation pick up materially in most developed markets and here locally as well. I mean, how is that going to impact equity valuations? Because that's definitely disproportionately benefited growth over more value-oriented names. When
rates were dropping, yeah. I mean, that's a 40-year tailwind to growth. An amazing, epic bull run in bonds that was one of many tailwinds for high duration assets. I think what's going to happen here is the Fed is doing everything it possibly can do to keep a cap on the expectations for inflation lasting longer than X. And it's kind of like one of these cross this line and we'll make another line. And the expectations for inflation 10 years out is still very low. It's like 2.4%. When that starts creeping up to 4, 6, maybe 7%, what is going to happen is I think no matter what the Fed does, if the Fed sees that growth is getting stifled, the book on the Fed is they're going to start cutting rates. That is growth above all else. They'll take growth over inflation. Because you have jobs. People have jobs and they feel like their number one job basically is to create employment. But what's going to happen to the growth stocks is even if the 10-year Treasury yield goes down and is forced down by the Fed, that's a signal to shoot inflation back higher. And the valuations, the dividend discount models, should shift from looking at the 10-year Treasury as the discount rate to inflation as the discount rate, which further hurts growth shares. Forever, that's the 10-year Treasury has been used because if the Fed is doing its job, it kind of matches inflation. If the Fed then artificially lowers that relative to inflation, you should be shifting back to first principles. What is that dollar that I earn 25 years from now worth back today? Well, that's inflation discounting. That's not an artificial government bond rate. So you could have an acceleration in the devaluation of long-duration assets.
And I guess, Cameron, it can also come through in the currency. So probably the most important long bond in the world, even though everyone looks at the US, is probably the Japanese market. So the Japanese central bank has said they will buy unlimited bonds at 25 basis points. In other words, for everyone, that's 0.25%. But the yen has just weakened 30%. So you're probably going to have inflation expectations in Japan at their highest levels forever. So you can control interest rates, but you can't control your currency, and something eventually breaks. Because I guess one of the counter to Alex's theories, I side with Alec, is a lot of people just talking about yield curve control. So after World War II, obviously the US had very high debt. They put it in there, and the Federal Reserve just said, we're not going to allow interest rates to rise. And actually interest rates did stay flat for a while. But when you have financial repression, it breaks out in all different kinds of asset classes because you're not allowing a clearing rate for the most important markets in the world, which are long-dated sovereign bonds. I mean, everything is priced off the US long-dated sovereign bond.
It becomes whack-a-mole, which is probably what we have now.
But whenever it pops up, you just hit it back down again.
They do something to hit it back down, then two more things pop up.
We saw a lot of volatility in global markets, and some of these really exciting so-called safe haven names dropped off. We saw a significant escalation in conflict in Europe, but actually South African markets fared quite well, and the rand sort of strengthened at a time where we announced a relaxation in exchange controls. If we'd predicted those events kind of beforehand, I'm not sure that we would have predicted the outcome that we saw. So what has happened locally?
So clearly, I think the strength of South African asset markets, and I mean currencies, bonds and equities, would have surprised people in the first quarter. It's weakened somewhat since then. You could say, was it skill by South Africa or luck? It's very much, in my view, the latter. I don't think we skillfully, navigated this any better than anyone else. It just so happened, that South Africa is basically a commodity-producing country. So we produce coal, we produce iron ore, we produce the PGM metals. And we can go into it later. I'm sure Alec has a lot to say about that. Underinvestment in mining for many years, inflation, supply chains coming back. It just created sort of a perfect sort of environment, and particularly some things in South Africa like PGM metals. Russia is a big exporter of palladium. There's a shortage of coal for energy globally. We happen to export coal. So South Africa has perennially been a twin deficit country. And what I mean by that means we import more than we export and we spend more than we earn. And you can't keep doing that forever, clearly. And what surprised everyone is with these very high commodity prices and a slow economy. Remember, imports normally grow fast when you're growing fast because you're importing equipment, you're importing consumer goods. So you had this combination of, our exports are just flying on price and our imports are dropping. And so you had a current account surplus, the currency is not weakening, that allows you to have lower interest rates. The windfall, even though the government messed it up a little bit, as we know, with all the coal sitting on the roads that we didn't export, the windfall tax has allowed us to, have the emergency social grant, which helped people during COVID and allowed us to cut the corporate tax rate. And normally in crises, we'd be going the other way around. So I think a lot of what we've been spending some time on in the team is trying to understand how sustainable some of these things are. Because if they are sustainable, it's not only obvious to buy mining companies, it's what we've always called the second derivative, the companies that benefit from this environment I've just described, which can be banks, which can be retailers, which can be insurance companies, etc. So yes, it is. I think it has surprised a lot of people, but the way we've probably described it best is it's papering over the long-term cracks. But there's no doubt. I'm not sure about this when I look at the margins of what the commodity companies are making at the moment. They sort of double Microsoft. Is that if this is the beginning of a long-term commodity bull market, and we're only in the first few years with a few bumps along the way, that's a tailwind for South Africa. And I saw S&P just upgraded our thing from sort of stable to positive, which I bet you a year ago no one would ever have thought was possible.
So Alec, what's your view? Is this the start of a long-term commodity super cycle, or is this just a temporary shift which has been caused by COVID disruptions and the escalation in Russia and Ukraine?
I think that the preponderance of our conviction is weighted towards this is going to be a much longer cycle than not. And as Duncan alluded, the conviction there comes from the lack of investment. So the old saying that high commodity prices solve high commodity prices is only true because CapEx comes in and builds production. And that's just not happening. It's it's bizarre when you look at these charts and you look at the chart of an oil price and you look at capex divided by revenues for oil companies, it's not coming off the bottom. And it's driven by ESG. It's driven by government edict that was driven by ESG. It's driven by a real fear that, maybe the commodity that I'm making will be illegal in 5 or 10 years. And it's going to do the exact opposite of what should normally happen, and that means commodity prices might continue to get higher. We're all, as professional investors, we're sitting there. The time to sell a miner or an oil company is when they're cheap on earnings and cash flow, and we're looking at them, and we know why, because here comes the capex. We're not seeing the capex at all. Schlumberger, Halliburton, and Baker Hughes are scratching their heads on the quarterly calls, saying we're seeing little upticks, but nothing like what the world needs to create more oil and natural gas.
So just on the counter to that, Aaron, because then the natural question may be asked by clients, or why isn't Allan Gray's top 3 shares BHP, Anglo's, Glencore, plus Sasol, plus the PGM counters? So I've been wrong about this. I've been right about it occasionally. I still worry, and we've done a lot of work at Allan Gray on the Chinese debt and residential and property and ability to invest at such a high level of GDP. Not forgetting that China is roughly 2/3 of seaborne demand for most commodities. So you sit with this thing in your head and you do understand the underinvestment, but you also sit on the other side and have this big worry that if you told me in a year China collapses, I wouldn't be surprised at all. And then the iron ore price, which costs about $40 to take out the ground in the Pilbara in Australia, could be 60. And then BHP and the Anglos are not going to be at the current share prices. So you have this weird sort of thing where you understand the longer term story, but there's also this back of your mind, you worry. And as an example, I think Glencore, which I think the clients knows are our biggest or our second biggest share, I stand corrected, but in one or two divisions, their margins are 60 to 70% EBITDA margins. This is not you loss making and things are really terrible. You are making lots of money. The big difference is the previous cycle in commodities, 2005 to 2008, all the commodity companies made acquisitions at the peak. They made greenfields expansions at the peak, and the new CEOs and the new boards are so petrified of being painted with the same brush, with the cold eye of history, saying like, you guys messed up, that no one is spending capex. So it's not just that they're not spending capex because they can't find it. They also, most of them are returning all the money via dividends and via buybacks. Now, buybacks are normally a negative sign in the commodity sector as well. But I guess it's just this judgment of, for me, the long-term story of underinvestment and inflation versus China's huge demand for many of the metals that South African commodity producers sell to them.
Yeah, I think we are on the same page. Our overweights in commodities are in natural gas, LNG, and semiconductors. So we've kind of painfully been more or less out of the other metals on the China risk, which is can't figure out why it hasn't hit yet.
I mean, Duncan's talking about some of the maybe the short-term deflationary pressures on commodities from China, but didn't necessarily argue against kind of long-term upcycle in energy. And if we think that ESG is holding commodity producers or oil producers from investing in capex, and we know there's supply constraints, what solves it? We know as a kind of globe, we want to reduce our dependence on fossil fuels and we want to kind of move to cleaner energy. But how do we balance the fact that, at the moment, Germany's thoroughly dependent on Russia for natural gas, and probably what's their long term prospects? Yeah,
I mean the number one thing is I'm waiting for a politician to put their hand up and say they were wrong. That yelling at their national energy champions to stop producing fossil fuels or to shut down your nuclear resources was the wrong thing to do. But a politician is incapable of saying that. So instead, now they're yelling at them to say, you didn't produce enough, and we need you to produce more, and we're going to put a price cap on what we pay, and we're going to charge a windfall profits tax because you're making too much money. So you said, what do we need to do? I think it's easiest for me to say, we do the opposite of that. The governments are just completely out to lunch, and they have effectively taken poor or ill thought out or short-term drivers that have been developed by ESG, and they've politicized them and created regulations and laws to be popular that were contra to having a really good energy transition. Now everyone's been caught out. The ESG people kind of evaporate into the woodwork, leaving the politicians to try and solve it. And they really don't know how, and they're kind of flailing at this point.
And if I can just add to what Alex said there, when you in investing, you're always learning. And I've learned a lot over the last 6 or 12 months about energy that I didn't know before. It's easy just to look at Sasol, but I think what I've learned is all these global supply chains are very interlinked. A shortage in natural gas here leads to a shortage of fertilizer here. Someone may have surplus natural gas there, but then the other country doesn't have import terminals because they've never imported LNG before. And so these sort of supply chain shortages, which end up in one area, end up going all across the world. And unfortunately, the one thing we're looking at is food shortages globally. And, I encourage everyone to read Talia, my colleague's piece in it was very good. And we look at countries like Sri Lanka and Kenya, they're real problems where you're short energy, but you export things which haven't kept up with energy prices. So I think that's the big thing that people perhaps have missed, that these complex supply chains are very, very difficult to understand, even for people who've worked in them for many years. I don't know if you agree, Alec.
Yeah, but it's the supply chain on the other end as well. And where we're seeing the best names in energy, best opportunities in energy right now are in the energy services companies. And what's happening is people have been out of energy so long and they've been so burned, a lot of energy expertise in investing has been lost. And they're not connecting the dots between a lack of a capacity and supply-demand mismatch with the future upside for a Schlumberger. And if they know a Schlumberger, most investors, professional investors, might know a Schlumberger.
Well, maybe you can give us a bit of a context as to what Schlumberger is for
Schlumberger is
the African audience.
The largest and most successful energy infrastructure company in the world. So they do the work. They do the high-tech engineering to get the well done properly, to find the right resource base, to do the 3D seismic, and to get the oil out in good shape. And they have a lot of people that work with them. But it's the only company that didn't go free cash flow negative in 2020. So very, very high-quality company. But under that, there are hundreds of service providers in the energy service space that need to knit together their contribution in order to get things out, including sand. You need tons and tons and tons and tons of sand to do fracking. You need fracking guns. It's actually literally an explosive that you shove down the pipe and it explodes to open the rock up. You need the pipe. And this is high-grade iron and steel pipe. All of these things have to fit together properly in order to get the stuff out. What you're seeing in the U.S. now is everyone expected the fracking output to come racing back because it's considered short-term, meaning you can put the investment in and get it out in 6 weeks or so, whereas offshore oil might be 6 years. It's not happening. So the supply chains, I think, on either end have been messed up, and you can make investments on either ends and take advantage of the dysfunction in the middle.
So is that where you would invest as opposed to kind of some of the shale producers in the US, which kind of at first glance should be able to be major beneficiaries of a short-term energy crisis?
We have some of those. But they are, it's too obvious, if you will. That's a first level thing. They're getting picked over by the investors. The big high quality ones are being bid up, and this energy service space is being neglected. Also, critical energy infrastructure is being neglected. Everyone's completely blowing off that if you get the Permian re-going and pumping more oil and gas out, you have a pipeline constraint to get it to the Gulf of Mexico. That's Kinder Morgan. But Kinder Morgan is sitting at a 6% free cash flow, 9% free cash flow yield, 6% dividend yield. It hasn't done anything. The stock's just been flatlining. You need this critical energy infrastructure. So these secondary and tertiary parts of energy, and if you looked at mining as well, Joy Global makes the big cranes that if you wanted to make a new copper mine, you've got to bring these huge, these monster cranes that we've all seen glossy pictures of. It's owned by Komatsu now. Komatsu's done nothing. The stock has done nothing. It's very cheap. And people just haven't got around. They don't have the confidence or conviction that this is going to last long enough to having to put more capacity in.
To me, Tamron, just the important thing that I guess shows me how important energy is the Russian ruble is stronger than it was before the Ukraine war. Just think about it. All the sanctions, all the banks not allowed to trade with them, the ruble is now stronger than it was before. And I was just reading up on a slightly different thing from what Alex said. It can also go through to industrial companies, because German companies and that metal companies in the middle of Germany, which are very important to the global economy, the precision sort of machine makers and that, they all depend on each other's parts as inputs. And now they can't do it without the gas. So you don't just stop one company, you stop a whole load. And I think it's more for, I guess, the Orbis portion of the portfolio than ours, but it is something you can definitely think about, because someone's going to have to rebuild this infrastructure and do these things. And I agree with Alec that it's a good space to look at, whereas people are looking at the obvious ones, which are the, I guess, just like with us, the mining companies versus the companies that benefit from servicing the mining company.
So, Alec, what's the overall exposure to energy and energy services related names in Orbis Global Balanced, and what's the most important or biggest exposure? So,
it's arguable what should be called what. So it's somewhere between 22 and 24%. And remember that's more than a third of the net equity exposure. So that's a hefty position.
Okay, and the largest position then? Or your most favorite name? Maybe it's not the largest.
So largest is Shell, and I think if we were just going straight off valuation, then that should also be my favorite. I don't really have massive confidence in their capital allocation ability, but it is super cheap on free cash flow. If you just annualize the cash flow that they announced for Q1, and remember they hedge, so the cash flow should be growing and growing and growing as we go through the year. But if you just annualize Q1, you can buy back every share and every bond that Shell has ever issued in 4 years. That's an insane valuation for a company that size and with that kind of diversity of energy exposure. But Kinder Morgan, I think, is probably the best managed and my favorite right now, because it's, I think, critical energy infrastructure or critical infrastructure, period. If you look at the investing environment that we're going into, we're moving out of high ROIC is the only thing that matters. And I think that we're going into things where you want critical infrastructure that has to be used for the next 20 years, where you have inflation-proof contracts with credible investment-grade counterparties. That's a Kinder Morgan. And great capital allocators.
It's like the old economy strikes back.
Old economy strikes back.
So, Duncan, when we think about the local portfolio, you spoke earlier and you said, it's a balanced view on the commodity super cycle, and that's why our top three positions are BHP, Anglo's, and I can't remember the other one that you said, Glencore. So when you think about how to manage the risks, the kind of interconnectedness that you spoke about earlier, and also possibly gain access to some of these beneficiaries, how would you describe how the South African portfolios are positioned?
So I sometimes worry that I hedge my hedges and you end up as average. But, for example, in my slice of the portfolio, Sasol's my third biggest share now. So even though we get access to great energy names through Alex's portion of the portfolio, South Africa, as we mentioned, is short energy. And if, let's just say, in an environment where oil goes to $200, let's use an extreme environment, the South African consumer could be under extreme pressure, and you want kind of a hedge in the portfolio that's going to benefit it. And Sasol's been through quite a few years of hell, as everyone knows. The share may be up 20 times from the bottom, but it's still flat over a number of years, and we think they're doing the right things. So that's one way of thinking about balancing it. So I always say that to people, oil can go to 200. They say, no, it can't. I said, well, it went minus. Why can't it go to 200? But so the number one risk we think about from managing a point of view, and we've said this in a number of our webinars and presentations to clients, is China. So the South African stock market has a very outsized direct and indirect exposure to China. So directly, the fairly obvious one is Naspers. More than 100% of its value comes from Tencent. Richemont, probably half its luxury goods sales come from China and Greater China. You're sitting with BHP and Anglo's, obviously somewhere between 50 and 60% of their revenue. If iron was high, even more comes from selling commodities to China. And so you just have this risk that if something went wrong there. And what I meant by the indirect benefit is what we described earlier, that South Africa unfortunately doesn't have many globally competitive export industries. People talk about we export cars, but those are subsidized by the government. So actually, what do we really have other than financial services and tourism? So it's good to we earn all our money from our exports to pay for our imports, basically through mining. So it's quite good to have stocks that are not exposed to that. And the example I always use is British American Tobacco, not only because we think it's cheap from an absolute point of view, but British American Tobacco has no exposure to China. And it's very interesting why it doesn't, because its assets were nationalized. Right? So there's a tobacco monopoly in China. And AB InBev, which I think is a good example of where we can benefit from the current environment in two ways. One, AB InBev only has around 7% of its sales from China. And most of the big consumer staple stocks are being smashed now on a relative basis because people believe they're going to have the biggest margin squeeze ever. So up until recently, as an example, aluminium was up 3 times. So you can imagine, what do you do with the cost of a can of beer now, right? Your input's gone up 3 times. And so we're slowly accumulating AB InBev, which we think is one of the great free cash flow generators in the world. And hopefully, we just build the position slowly as it underperforms when people are selling off the consumer staple
Has
shares.
it come off a lot?
Well, relative to something like Richemont, up until a week ago, it was probably down 75% since it listed in South Africa, and probably versus the S&P, I'd say 60, 70%. So they had $100 billion of debt. They're bringing that down a lot with the cash flow they're generating. And they're pessimistic people in the world, and I'm normally one of them. But the one thing I'm not pessimistic on is people going out to party and have a lot of fun over the next while. And sort of the anecdotal evidence we've had from speaking to one or two of the international companies and from AB InBev is hotels, flights, people just want to get out there. And I think one of the interesting ways to play the reopening is not just obviously through airlines and hotels, but actually, the off-premises and on-premises sort of alcohol sales from AB InBev and companies like that could do pretty well.
Okay, so just going back to Naspers, and you talked about how dependent it is on China. So we've seen an almost halving of the value in kind of recent times. And, the thesis that the discount to intrinsic value or the discount to the kind of the holding company discount would actually protect us didn't really hold up because it widened even further. So is Naspers actually should be very attractive now?
It should be in theory. And I do think Naspers is probably the most complex sort of position we have in the portfolio. Because for many years you held it, and even if it was one of your 3 biggest shares, it was still a negative alpha contributor because you just couldn't get to the weight it was in the index. Just to remind everyone, the discount went from about 40% to 70%. So in other words, as Tencent fell, Naspers fell more and process. And our colleague Tim wrote a very good article explaining it in the QC in more detail than I will now. What makes it difficult is it's not a spreadsheet problem. It's not a problem of how good an analyst you are. It's what do you do if you wake up the next day and there's sanctions on China? And don't forget, Naspers has shifted the ownership of Tencent to Prosus, which is listed in the Netherlands. And I just can't see the Netherlands siding with China and Russia. I could see South Africa siding with China and Russia. And then we saw what happened with the Chinese stocks, the Golden Dragon Index. The day after the Russian stocks were suspended, everyone just sold the Chinese stocks first and asked questions later because they don't want to be stuck in the same situation. So Tencent is still in the same competitive position. Yes, ByteDance, which owns TikTok globally, but I've forgotten the name of the local product in China, but growing extremely strong. The competition's going more. Same as Alec mentioned with the cloud. I mean, it's just them and Alibaba. The banks are coming under regulatory pressure, so the fintechs within Tencent. So it's not the company it was, but it's still an incredibly strong company with strong moats. But I think it's more valuable to a Chinese investor than a foreign investor because of these risks that you can't really quantify. So what we've been doing is limiting the position size, which has turned into a good idea. I think Alec might know that one of the biggest mistakes you can make is if you average down and you're not sure, because then you think, well, I've only put 2% of position into this one stock, but actually you've invested 6% because you were buying the whole way down. And that looks fantastic when it works out, but it can look really terrible when it goes the wrong way. So we've almost let the position sink to a level where we feel comfortable today. And what I meant by in hindsight, I think in 2-3 years, someone could say Tencent is down 60%. It was a fantastic business. Naspers was a 70% discount. This was the buy of a lifetime. And the same person could say to you in 3 years, well, Chinese stocks are sanctioned. The Chinese economy has imploded. They've invaded Taiwan. How could you have owned this when you knew the risks that were out there? And I think that's what just makes it such a tricky investment proposition at the moment.
Isn't there an element of recency bias, though? I mean, we're sort of worried about the sanctions because we've seen it play out in kind of common prosperity over the past sort of 6 to 12 months. And it's one of those low probability but high impact events, which are actually quite hard to incorporate when you're valuing a business?
Yeah, so what we've tried to do, I think it's very arrogant for someone on the southern tip of Africa to say they understand what's going on in the Chinese Communist Party. Just to remind everyone, they're not elected. There's no voting polls, right? So whether the population likes you or whether the population is dissatisfied. And I think what we've tried to do is we've tried to find people who are very bullish on China. We try to find people who are very bearish. We try to find people who call themselves realistic. We've spoken to our colleagues in Hong Kong, which I guess is China now, the Orbis emerging market team. And we've tried to get a whole lot of different views and bring them in. And it's amazing how experts, they can all be experts, but they come up with very different ideas. But I do think whatever you thought Tencent was worth, it's worth less, because the CCP have made the way they're going to act in the future far more transparent, in my view.
And Alec, when you think about China and the China exposure and what you can access there kind of for the purposes of putting together the Orbis Global Balanced Fund, where do you see the opportunities? Have you invested in Naspers or Process? And if not, why not?
We've been very light in the Chinese internet names. And from a balanced fund perspective, we felt better in the dividend yielding, much more diversified big semiconductor names, so the Taiwan Semi and Samsung, where they sell to everybody, and they are the countries are behind them as national champions. You might see the chairman of Samsung get thrown in jail every other year, but that just seems to be a Korean thing. But Samsung Electronics is the most important company in Korea, and Taiwan Semiconductor is the most important company in Taiwan. So we've had about 8% of the portfolio on average over the last 3 years in those two names, and a 2, 3, 4% in the Chinese internet names. Now I think we have just about the same amount of hedging as we do NetEase and Naspers. But one thing I'd want to mention about the unusual time we live in this regard is for a company like Tencent, which is an incredible company. I mean, there's maybe 5 companies in the world that are as accomplished and excellent and well run as Tencent. The gradient that it has between what the downside case could be and what the upside case could be is bigger than you would have with a $500 million U.S. tech startup. It's just absolutely crazy. You could have the Chinese Communist Party wake up one day and nationalize them. That's entirely possible. You could equally have, and I think what we're thinking about increasingly here is you could have a change in attitude, and I think I'll leave it at that and won't go into how you can have a change in attitude in China, but we can probably let our imaginations run wild, where we wake up one day in October or November to we're going back to national champion tech companies, and we're going to rejoin the global community in commerce, and we want to make everything for the rest of the world. We could go back to where we were 2-3 years ago, and Tencent could, add a zero on the back of it? Just incredible.
That would be counter to most of the science that we've seen, across the globe, because that would be going towards globalization as opposed to everyone trying to protect their turf.
And that's why weirdo contrarians think about these things.
So Duncan, I just want to go back to, we talked kind of earlier about how South Africa there would be a tailwind for South Africa if we saw a longer run in the commodity market. But there are obviously a lot of other factors kind of which play into, consumer strength and the kind of average kind of corporate governance and strength of corporates and SAs. So maybe the one thing that's on a lot of investors' minds, or when I speak to advisors, it's kind of how does our own peculiar energy crisis, and so our electricity shortage, how does that play out in terms of dampening growth over the next 3 to 5 years?
So I think when we look at it from a company point of view, obviously it's not great, right? You run factories, your lines have to stop. Lots of these things have to keep running, especially the big manufacturers. You can imagine the mines. But interestingly enough, it does show you what you can do when you have to do it. I mean, the energy consumption and usage of most South African companies has just dropped massively. I'm talking outside the big mining companies. I mean, the retailers, because you had to reduce your energy usage because the price was going up 15-20% a year. So one, the people have become more efficient. I think two, obviously for the companies, leaving aside the obvious effects, you become less profitable, right? Because instead of building a factory for 100 Rand, you have to build it for 115 because you have to build backup generators. You have to go and build all the things that can keep the factories going during blackouts. So it's not great. And I also think it's not great for consumer sentiment, right? When you're sitting in the dark and it's cold. But I think Alec and I were chatting about it before the podcast. When you look at South African bonds and you speak to people who avoid them, they think about the catastrophic scenario, right? Which is a blackout. So not load shedding. That's you wake up and we like Nigeria or Zimbabwe where there's no electricity for like days. And obviously that's a sign of a failed country normally. If you look at places where there are blackouts, and Alec would say that's probably California. When you look in their blackouts, and there's
another failed country.
That's the real downside. You don't want to wake up and it's, you look on the app and it's stage 9 or 10. That's the real problem. I think if it stays where it is, it's not great. It's not great for growth. It's not great for the country, but you can get through it. You adapt, right? You adapt. But it's really that really bad scenario. I think what we worry about more, what's come from it, is when I look back, there used to be lots of listings of good businesses. I'm not going to say just listings, right? And, I haven't seen a new Mr. Price. I haven't seen a new Aspen. I haven't seen a new Discovery, businesses that come onto the market. And I think if you're going to start a new business in South Africa, it's pretty challenging, right? And now this probably just makes it more challenging.
I mean, I guess the counter view, and I'm a bit more of an optimist than you are, is that margins are depressed because businesses have had to run at a structurally higher cost than they would, in an environment where electricity is more freely available and businesses are more adaptable, and presumably this is well known and therefore all in valuations.
So if we look back there are two ways to look at it. If we look back when we had a really great 6 years in the beginning of the 2000s, South African consumer shares were amazingly cheap, right? Margins were low. The economy hadn't grown for a long person. Interest rates were high. So interest rates were going to come down. And then you had this massive volume growth in the economy as we can debate how sustainable it was over the long term, but lots of government spending, social grants coming in for the first time, a bit of a mining boom, and that moved the economy. And yes, the earnings went through the roof. If that happened again, the same thing would happen, right? You're not buying companies in a country that's been growing 6-7%, that's been attracting lots of competition. If you had to get volumes going through most of our business, our banks want to lend. Our manufacturers want to manufacture more. It's just the demand is not there. And if that had to come through, I agree with you. And plus, we were pretty under-owned by foreigners, which is something that also happened in the first 3 months. We used to go to investment conferences and all the big global asset managers would be here and they would be paying 20 to 30 times earnings for our consumer stocks, saying they're the best run consumer stocks in emerging markets. That could happen again, but it's not there now, to your point. It's not in the current prices.
Can these pledges of loans and covering loans and stuff that are sort of seem like they're flooding into South Africa, can that provide a catalyst for this?
It could, but I think things are actually doing stuff. I mean, we had money to build Kusile and Medupi. Just they went like 10 times over price and nothing ever gets done here. I think that's the real problem. I was remarking to someone the other day, when you look at the problems, when you come from Cape Town airport and you look at the housing problems they have, you go to the Philippines, they build like half a city in like 3-4 months with those big property developers. Like, why can't we just get 5 of them to come here? But the problem is then lots of people aren't making money on the side. So, we need to produce things. But if the Western world is happy to give us lots of money, I'm sure it's better than nothing, right?
Yeah.
Is it talking about the Western world possibly giving us money then, Alec? If you were to look at South African bonds relative to US bonds, and we know that South African bonds are, the 10 years are close to 10.1%, and US is closer to 2.3%. And US inflation or short-term inflation is higher than South African inflation at the moment. And this is sounding like quite a leading question. Would you, of the two, what would you invest in? And would you be worried about the blackout scenario and outcome that Duncan just alluded to, which is why foreign investors, some of them, don't buy our long bonds?
So the bonds look cheap, and Mark Dunleavy has been pinging me on them for months and quarters. But it didn't really dawn on me because I just didn't listen to Mark until he came down here and saw presentation after presentation that showed, SA with lower inflation and higher rates, which is, how often has that ever happened?
You did look at Brazil, then.
Yes, we have looked at Brazil.
South Africa, yeah.
We have looked at Brazil. And we decided to own the banks in Brazil. It's just an easier way to play it. It's more liquid and just less risky in getting the trade done and keeping up with it, really. The banks we know. We've been in Itaú for 7-8 years. It's just a good reason to buy Itaú. So it looks interesting. And when I look at the problem with Eskom and this constant reminder that it delivers to people when they come down here to consider owning SA bonds, and they're in the hotel and the power goes out at 7 on the dot, and then 5 seconds later the generator kicks in, that certainly puts that question mark in the back of their mind. But the way I would view that at this point would be that's fixable, and now I have a reason for why they're priced the way they are. Because oftentimes in contrarian investing, if you can't figure out why it's priced where it is, who's worried and what are they worried about, you shouldn't go near it because it's something. So I think, yeah, it's interesting. I don't know how much it would make sense to buy in something like the balanced fund when we are attached at the hip with Allen Gray balanced, but it could be interesting.
So maybe just one thing on that, Cameron. So I always think the very important number in South Africa is 10. And what I mean by that's what the 10-year bond trades at. And whenever it's gone above 10, the great financial crisis, Nene-gate, Corona-gate, everyone bought it, right? So the buying area was as soon as you go past 10, if that changes, you'll see people won't buy it. And that'll be the signal that foreign investors and local investors have changed their mind. Effectively, 10 becomes the floor, and there's a different ceiling rather than 10 being the ceiling and coming back down. I think it's a very important thing we watch from the fixed income side.
And the last thing for us is when you're buying a bond, you're buying a currency. And it doesn't make any sense to hedge the currency when you're buying a bond, except for the Japanese who do all kinds of weird things with carry. But the rand is just too expensive to hedge anyway. But the rand looks interesting compared to the dollar. The dollar has just been a rocket ship for transient reasons, whether it's Ukraine or
upward trajectory rocket ship.
Upward trajectory for the country that has the worst balance sheet in the world, worst big country balance sheet in the world. It makes no sense. So something like a rand could be a good place to hide, and if you do it via 10% yielding government treasury or something, it's a great way to do it.
And Duncan, I've often heard you call the rand the random. What's your, where do you think the rand will be in 5 years' time?
First one is compared to what, right? So Alex
to the dollar.
Alex talking about the dollar index. So the dollar's been strong against everything, right? So the rand's actually been stronger than people realize if you had to compare it to the euro. So yeah, I mean, in a commodity bull market, I could see us depreciating just by the inflation differential. But the way I've always said to people is if the rand is, let's just call it 15 Rand 50 today, I'd be more surprised if it was 8 than it was 25. That's how I think about it, because you're never going to know where the currency is going to go. You have this asymmetry in your mind. As I mentioned earlier, the yen has depreciated 30%. Japan's not some backwater emerging market. In a year, they've lost 30% of their currency. And, sitting in South Africa, we're used to currency fluctuations. Many of the people in developed markets are not. And then I start going, wow, would I want to invest in the euro? I'm not sure I'd want to invest in the euro. Japan's probably printing as much money or more money than the US. So, yeah, it becomes a little interesting. And when I look at the stock markets that have been strong in the first quarter, it's been Canada, mining, Australia, mining, South Africa, mining, Brazil. The Brazilian real has been stronger than the rand. Okay, it came from a worse area. So you can kind of see the trends that were there. And that's despite a strong dollar. I do think the one thing that people do underappreciate a bit, and we see it a bit when we look in Africa for the Africa funds, is if you have dollar debt, which lots of companies do, right, because they borrowed at low dollar rates, or countries have dollar debt, guess what you need to pay your debt back with? Dollars. So that's why there's often a demand for dollars. And if you don't have dollars, you scramble to get them. And it's one of the things I've never got my mind around. In Nigeria, sometimes you can't find $20 million, but the US will print $1 billion in a day. So instead of sending a whole lot of US college students to Nigeria to do university VAC work to help people, just phone Jay Powell and say, please send $1 billion of that over that you print every day. It doesn't cost everything. And it's one of the bizarre things about the world at the moment with economics.
So, Alec, how do you think about the currency risk that Duncan's just talked about from the perspective of the Orbis Global Balance Fund, you can make active currency decisions. If you're worried that the currency that constitutes the highest weight in the index has the worst balance sheet, and some of which has been tailwinds are now to become headwinds, how do you diversify against that risk? A lot of gold.
We've been cutting back the dollar for a long, long time, and it's been wrong. Right now, we're just continue to increment towards the resource currencies. So, as mentioned, the Canadian dollar, the Aussie dollar, the Brazilian real, Norwegian kroner. So far, not the South African rand, but it's in that same group, and taking from the euro. So 6 months ago, it would have been out of the euro into those resource currencies, which turned out to be a timely thing. Also out of the pound. And just to remind everybody, we don't look at currencies as a money-making operation. We use currencies to toggle or moderate the risk that we have in the bonds and the equities. So understanding that BP is not a pound currency, and Mitsubishi is not a yen industrial. We have to do all that math off to the side and figure out what our real currency exposure is in the portfolio, and then use hedging to get back to where we think a reasonable place is to be to maintain purchasing power. And that gold, which is the ultimate hard asset, we consider to be both a commodity and a currency. We use our viewfinder both ways, and there's compelling cases on both. But just considering it as a currency, nobody is printing gold. There's some dude printing dollars like crazy. There's someone printing euros like crazy. There's someone printing yen like, the machines must be redlining. And there are people printing cryptocurrencies. Maybe not Bitcoin, but the total cryptocurrency base is expanding wildly. And people don't just say, well, I'm not only investing in Bitcoin, so I don't care. People sell their Bitcoin to buy the new coin, the new cool coin. So the cryptocurrency issued by God 7,000 years ago seems like a decent place to be from a currency standpoint.
That could open up a rabbit hole and a whole lot of crypto-related questions, but that would be an episode on its own, yes. I think. So I want to just go back to kind of talking about some of the actual individual decisions that we would make in the portfolio. So if we think inflation is going to be a problem locally and globally, then surely we would want to own the businesses that have much better pricing power and are more durable. So we should be buying more of Mr. Price and ShopRite and not owning Woolworths.
So, our biggest share has, I think, the best pricing power, which is British American Tobacco, because people are used to cigarette prices increasing every year, and they seem to have managed their supply chain pretty well. We own Glencore, which we're a beneficiary, although mining companies are also going to face inflationary cost pressures, which we've already seen in the latest set of results. And Alec might be able to comment more if we have time later. But Walmart and Target have been smashed the last week. Walmart we consider probably the most stable retailer in the world. It's super powerful with its supply chain, and the share fell 20% in 2 days. It just couldn't pass on the cost of goods. So it's getting a basket together. I don't think there's any company in the world that can pass on the kind of commodity increases we've seen. But we also try to avoid companies like the telecoms operators. Most people just expect their data prices to fall all the time. Voice costs fall all the time, but probably 30, 40, sometimes 50% of your costs are in dollars, because Ericsson runs your network. You have to, if you're not MTN, you have to run your towers in Nigeria with diesel generators, because, there's just not electricity supply. So we do think about it a lot, but I do think the squeeze could be pretty epic on most companies once the hedges roll off. And I think that's what we haven't seen. Most companies have hedged their input costs, like 3 or 6 months or 9 months in advance, and as those roll off, they'll be exposed to spot input prices.
Alex, so if we look at kind of how the markets pulled back, we started off the episode talking about it. Surely some of these names, some of these technology names are looking attractive, or am I falling into the same sort of mistake that you spoke about, that people say, they like 17, 18 times and...
You're pretending to. We have been assigning a name each of these fallen angels that have been mentioned in the past as the next Microsoft or the next Amazon. and they're down 60, 70, 85%. We'd like to get the next Amazon or Microsoft. So it'd be fantastic for us to be able to do that. And they are down a lot. So we're working on, these are things like Palantir, Upstart, Netflix. And when we look at them, I think I wouldn't put Netflix in this category. There's no there in a lot of these. Or they aren't close to what they're being advertised as. And take something like a Palantir, which people may know or may not know. But Palantir has been billed by Wall Street as the ultimate intelligence consultant or intelligence app, and uses AI and machine learning, to produce amazing results for the Defense Department, for the government, for leading countries and companies around the world using this incredible AI thing. I think AI is in every sentence. When we tore it apart, it's a consulting company that has an AI engine almost as a marketing tool, where all the data that goes into the AI machine has to be groomed by people. And then the machine puts something out, and then you have consultants on the other end that do a bunch of work on it, and then they make a recommendation. No different than KPMG or E&Y or Accenture or any of these others. So that's kind of what we're finding is a name that's wrapped up and marketed as one thing is actually something much more mundane.
Maybe the one difference is they might have paid their employees more than they paid Duncan in his first 2 weeks.
Well, they paid him in stock, so they didn't pay him anything.
So you said Netflix to one side, Duncan. Netflix has made a significant investment in content over the last couple of years, and we all know content is king. Would you own Netflix or MultiChoice?
Well, as you know, I'm a bit of a contrarian there. So I've owned MultiChoice for a while. It's exactly that kind of stock that I think reduces the risk in the portfolio. Very strong moat, very big cash flow. They've got a big division in Africa, which is still loss-making, that's coming back to zero. They're the biggest local content producer. And what I really love about it, it's actually one of the interview questions we asked Cameron when people come to the investment team. From today, in 10 years, who will have greater revenue in South Africa, Netflix or MultiChoice? And almost anyone under the age of 25 says Netflix. And they have no idea what they're talking about. I mean, MultiChoice already makes over 10 billion rand operating profit in South Africa. It's got sort of 9 million subscribers. They're going to be the biggest content producer. And I'll tell you something that's very interesting. MultiChoice is up 5 times versus Netflix over the last year. So it was very interesting, as Alex said, you often get these narratives, and you stand at an investment conference and say, I like MultiChoice. People say, but I like streaming. And then they forgot, well, there's Disney, there's Hulu, there's Amazon Prime, and all those ones. Guess where you access all of those now at a discount? On MultiChoice, on your similar thing. So yeah, it's a contrarian one. I'm not sure it's going to work, but it's a very defensive stock, and it's something we would own to a great extent in the stable fund, for example.
Of course, now that you've told everyone what our interview question is for an analyst, you're going to have to get another one. Alex, I got one sort of last question for you, and it's a bit of a sort of philosophical one. So right at the very beginning, I asked you kind of what do you think people are missing? So maybe I would say reframe it slightly differently. We've talked about a lot of the issues that are maybe quite well known or well discussed. So an energy crisis and the food crisis and inflation and commodity cycle and but typically actually what disrupts markets is the stuff that we're not talking about. So if you were to give kind of one parting piece of advice for people listening, what would you say they should actually be cognizant of? So what's the biggest risk or the biggest upside opportunity?
We've had 14 years of high ROIC only, safe, predictable, great story companies being the place to invest. That's 2 or 3 generations of investment analysts in our industry have only known one type of market. And if it's one thing I feel confident in, I can guarantee that the next 12, 14 years aren't going to be like that. I don't know exactly what it's going to look like, but I know it won't be that. So my piece of advice is figure out what you think it's going to be like.
Okay, Duncan. So now if you think about the Allan Gray Balanced Fund and, as Chief Investment Officer, you're responsible for the overall kind of performance of the portfolio. What would be the one key takeaway from this that you would want advisors to kind of go away and tell their clients?
That we think about things a lot. It's not easy, right? You can, as I mentioned, you can hedge your hedges, you can hedge the hedge that hedges something. This is very difficult, but we do think a lot about putting the portfolio together. As you mentioned, it's not finding the 20 cheapest ideas or the 20 best ideas we have and ranking them from 1 to 20 and sticking them in at an equal weight. We do think a lot about how different scenarios in the world and how, that could affect the portfolio. What that means is it would be nice to be the number one manager, but it's not what we're aiming for. We're aiming to give people a great return through the cycle. And sometimes that means you could be right near the top, and sometimes that could mean you're right near the bottom. But we're going to do, what we think is right from a risk-return perspective.
Thanks, everyone, for listening to today's episode. It was a wide-ranging conversation. We started off talking about the global market volatility and the sell-off in tech names and whether or not this is the end of the sell-off or the start. We talked that extended into discussions on the energy crisis, the conflict and the human tragedy in the Ukraine, how this is moving into higher commodity prices, but ultimately, how are we thinking about all these global and macro events to make the best investment decisions and position the portfolios for what we think look like a wide range of future possible outcomes. We welcome your feedback, suggestions and questions. So please drop us an email on info@allengray.co.za if you'd like to provide your perspectives. Finally, please remember that Allen Gray is an authorized financial services provider. If you want to view the T's and C's, explore the latest investment insights, including any articles which may have been covered or mentioned in today's episode, and to find out more about our product offering, please visit www.allengray.co.za. Until next time, I'm Tamron Lam from Allen Gray.